Hey guys, welcome back to Seller Sessions 4 p.m. BST on a Wednesday afternoon. Joined to me today are two leading lights from Fortinet in Yao Kabili, and Mikhail is with us as well. And then we've got these friendly, happy gentlemen. We've got Rob Bell from Elevate Brands, Jim Mann is here from Frasio, and Nate Jackson from Perch. Today we're going to be talking about you've probably seen it fly around the internet just recently, especially within the groups. It's been shared. These two guys are put together a PDF documentation of what buyers are really looking for. And so today we thought we'll bring on obviously some of the people in the space, key people in the space that are buying up Amazon businesses, and find out what they really want. And they'll tell you from the horse's mouth and some of the discoveries that Mikhail and of course Yao have had. So Yao, do you want to kick things off? Tell us a little bit about how this come about, and we'll go through some of this data.
How we started the survey and
Yes.
why.
So why did you do it? There's always a why, isn't there?
Yeah, always a why. So at Fortinet, we're an investment banking firm. We help sellers selling the business, and we've been talking. We speak with, I don't know, 4 to 10 sellers per day, and we felt that there were some misconceptions about several topics. And we had our reality, what we see when we go to market with a specific business. But we felt we wanted to see real data. So what we did is we asked the buyers. We went to 42 aggregators, most maybe all the largest ones, and the rest, and we asked what they really want. So we asked questions about the categories, the number of SKUs, how to structure the deal and everything. So that we'll have the real answers, and the answers are in the report.
Excellent. Mikhail, is there anything you want to add to this as well? Because you played a role in putting this together as well. What are some of the insights that really stood out for you? Because often when we do things like this, when we're testing things, we have our own assumptions, right? Oh, this is going to come out of this. And then you get the shocks. Talk to me about some of the ones that you're kind of shocked with the results for. If you will, of course.
Yeah, I think that in most cases we got verification to things that we already knew, but things became more clear and sharper, such as how those aggregators see the future, the fact that they are well focused around Amazon business mainly.
Yeah.
But altogether, I don't think that there were major surprises, but more verification, and it put things in order. We did see that there is a consensus around certain things, and around other things, different buyers take a different approach.
Yeah. All right. So first things, this is going to be a key thing because everyone in the industry wants to know this. Who's going to sell? Is like, do you where does the maximum value come in terms of multiple? So for instance, are you going to get a better multiple if you sell off Amazon? And if you do, why? Starting off with, say, Nate first.
It's a good question. I think sometimes people feel like the best value you should get for a business is when you're doing everything you could possibly do. And sometimes that does actually happen in the marketplace. But as a buyer, in many cases, like I want to have something left on the bone that we can go do, that we can go drive. And so if somebody's in all geographies, fully penetrated into, multi-million-dollar accounts, into some brick and mortar retailers, in some ways that's like great validation that it's a winning product, but also there's less to go and drive. But at the same time, there's a whole bunch of products and brands that probably don't have a rightful home in say Walmart or Target. And so I would say the brands we've been most excited about have been somebody that, it's not a matter of like, okay, I'm getting 2% of my sales from Walmart Marketplace, but somebody who's gotten to the point where, they're getting 15, 20% of sales in brick and mortar.
Yeah.
But they're saying this is spiraling out of control. It's too much work. I'm already at the point where I'm going to have a life-changing exit, and I need somebody that can take this from where it is to a full-scale consumer business. And so what I would say is like, definitely don't set up a Shopify account just because everyone says you need to, and like distract your energy to go get $200,000 of sales there if you've got a $10 ASP and you're never gonna like really drive meaningful product there. But if you're getting calls from wholesalers, trying to get you into Target or Walmart, you should take that call and you should take it seriously, take it as far as you can. But there is a point where, these businesses often start with two founders, and you've got to make the decision, like, do I want to build a 20-person team to take this to its full potential? Or is that sort of stress not worth it because I'm going to have, again, a life-changing exit on the other side of this anyways, and kind of want to participate in the upside, but also not have to drive every part of it.
Cool. Well, I'll dial in on the question more because it came out not necessarily 80%. So within this report is, do you offer higher multiples for businesses selling on other platforms, Walmart, eBay, etc.? So you kind of covered that. Jim, what's Thrasio's stance on this?
And before that, I think the thing I loved in the report was all the myth busting, because a lot of sellers spend time what they think is de-risking and going on other channels and setting up complexity for not a huge amount of revenue or profit. And that's the first thing that I'd encourage everyone not to do. So don't listen to all these gurus that tell you to set up on Walmart and set up your D2C platform, because you're not going to get more money for your business. You're going to add more stress to your life. So that was great. Like that black and white core message in the report was brilliant. And then what was the second part of the question, Danny?
Well, really, like it goes back to 8%. It's saying it's not necessarily relevant in terms of, do you offer higher multiples with businesses on other platforms such as Walmart, eBay, etc. Really, it's the more benefit is going to come with the volume of revenue. I from my understanding, you can correct me if I'm wrong. Yeah. If you've got 30% of your revenue coming from a different source outside of Amazon, that is an attractive proposition. There's an opportunity to grow there, right? But if it's less than that, it could be just that it's a bit of hit and miss, and you've got lucky on that platform. But you don't know how long that chain is going to run for, Yeah,
if it's scalable, then it's attractive. I mean, I think any acquirer needs to look at the historical performance, and that's what we're all doing. But more importantly, now we're trying to work out what the future looks like, and that's the bit. It's harder to know than ever. And like the last 18 months has just been crazy between supply chain, COVID bumps, search traffic has gone all over the place. So I think the bit we're all trying to work out now is what you've done is interesting, but what are the category trends? What are the growth trends? What are consumer behavioral trends, and where do you then back your team to get in and deliver growth? And I think that's where we're all probably looking, is trying to look at future trends rather than historical performance as much as anything else.
Yeah. What's your take on this? And then I'll go to Rob next as well. We won't forget him.
Yeah, so it actually proved, this is one of the most common misconceptions. We had, on calls with sellers, when we discussed their plan, we were sometimes in touch with them a year before they sell. And we often speak with sellers, I'm going to sell in 4 or 5 months. And I was thinking, to increase the value, I'm going to open a Shopify and invest, my time now in that. And so, what Nate and Jim have said is exactly true, and what we've been saying. But now we also have the proof that it's not, if these are not real sales, if it's not significant, and you just open the Shopify just to tick the box, that doesn't work. Buyers see what you see. And I wouldn't spend my time on that. I would spend my time on what you do best. If you have 4, 5, 6 months, then launch new products or do things that and not new adventures. Except for cases like Nate said, where somebody comes to you, take that call. But now we have the proof.
Cool. Rob, I can ask you the same question, but gone around the room. But let's move to the next one, is the buying trends, right? It says, how many business do you intend to buy in the next 12 months? So we've got here, the highest peak of the chart is at 28%. There's 15 to 20 businesses. Where do you guys sit? Obviously, it's going to be about quality and buying the right kind of business. But what is your target for yourself that you set as a high bar?
Who first, me, Danny?
Yes.
Or?
Yeah, you. Sorry, Rob.
Yeah, look, I think it's an interesting question. I think if you wound back the clock to the start of this year, it definitely felt like a bit of a land grab. Every aggregator who had raised capital was trying to buy as many businesses as quickly as possible. I think the bigger, more established groups who have the operating pedigree, we're kind of moving forward with confidence. We're definitely focused now on bigger businesses and buying high quality assets rather than just trying to buy any assets to put in front of us. I think as a target, we're probably looking to acquire, between 2 and 4 businesses a month. We'll probably ramp that up depending on, team size. One thing we've got to be cognizant of that I think every seller doesn't appreciate is, it takes a big overhead to run these businesses. And I think that's something, particularly at scale. And that's something which I think will put a cap on multiples in the future because we've got, big teams to run these huge portfolio of brands and take them internationally. So we're probably targeting 2 to 4 brands a month, but obviously slightly bigger businesses. So obviously we'll be growing, bolting in more earnings at kind of bigger ticket sizes.
Cool. Same question to you, Jim.
Yeah, much the same. I don't think it's the number of businesses, Dan. We're just, look, our collective business model is very easy. We just have to buy brands that we can profitably grow and outperform the categories in which we operate. And as long as we deliver that, we can keep raising money and the story continues. So for us, it's about growing revenue. It's about maintaining profitability, and the drivers of that are being very selective in the categories in which we choose to acquire going forward. So, just building what I think all of us are just thinking much more future focused. Like the operating environment now versus 12 months ago is much more complex. It's a much riskier bet for everyone involved, and anyone selling on Amazon or e-commerce in general knows that right now. So we're just getting much more disciplined and focused. So it's not number of deals. We're trying to, grow revenue aggressively and maintain profit. And the only way you can really do that, no matter how good your team is to pick the right categories.
Yeah. Nate, you're muted at the moment. If you would just pop yourself off mute.
Yeah, I agree with both of the comments that beginning of this year felt like a land grab. And the world has changed a lot in that period of time. The supply chain environment is much more complicated. Profitability is more challenging with rising ad costs and supply chain costs. And so totally agree with Jim's comment that the most important thing once you've achieved scale is, building a portfolio that you can go and add something of differential value to. It's got to be on the back of good fundamentals, and it's got to be aligned with your operating strategy. And I think, everyone in this call has organizations that are building teams, as Rob was saying, that are oriented around driving profitable growth. And so we're in the same boat of looking more and more for what is the lie of the ball that we can go and really drive that, where we are the best owner possible, because it's a pretty efficient market. And, there are deals that we would like to own at the right price, but that we can't chase if we don't think it's worth it. But when we see something with confidence that aligns with our own operational strengths, we're going to go after it pretty aggressively and pretty hard.
Yeah.
I don't, I think that the ability to predict the future is really challenging right now. The supply chain world is crazy. It's so hard to know, how should we fundamentally value a business that has bulky products and, our container is going to be 20 grand or 75 grand or 7,500 or what. And so there are some places where it's an easier assessment than others, but I do think that there's a meaningful shift in kind of how people are thinking about velocity versus quality and everything like that.
Yes. Yeah. Do you want to bring up the next question? Really, is categories. I think this is really key, because one of the misconceptions there is that, aggregators won't touch X, Y, and Z, and it's good to kind of get this analysis out there. So I'm just going to add this to the stream now. Could you expand the page, just a little bit, because I think just blow it up a little bit. Here we go. So you can see here, when the break, do you exclude any categories when purchasing an FBA business? Which is the ones down to there. Any categories when purchased at FBA business, you can see obviously clothing, 52%. Who wants to have all those level returns? That kind of makes a lot of sense. Electronics, very competitive, if you've got a Chinese factory and you're competing on Amazon, why would you go up against a factory? Their supplements is a tough one, you know, where they say there's muck, there's money, and there's a few people in supplements without scruples. Food can get thrown away, as we know. Any fashion product, obviously, that goes through a cycle. But then let's go up to the other one above. Yeah, the ones just scroll down.
The one that they like. Yeah.
There you go. Right. So here we go. Home and garden, pet supplies, baby products, outdoors, health and so there's plenty of stuff here to look at. So going back round the room just quickly, I know I was joking about supplements. Not everyone is bad who sells in supplements. That was a joke. But, you know, it does, it encourages a site, different characters, shall we say. I'm going to get my shovel and keep spooning it into my mouth as I'm digging this big, deep hole for myself. The point I'm trying to get to is, as aggregators, you're probably going to think supplements. Then you think Black Hat, and he's like, do I want to touch this? So starting with you, Jim, if you looked under the hood of supplements, what is your first thing that you think about? Is either, is this smothered in Black Hat, or am I going to go into a category where I've got to deal with that kind of stuff?
I mean, supplements have some very aggressive actors.
Yes.
The cost of acquisition is very high. So you have to bleed quite a lot. You have to be very, very good on your advertising. Yeah. You know, you've got two kind of gorillas and the sort of in the Black Hat spheres. You've got the Chinese operators and you've got the kind of the subs guys who act pretty similarly, just located in a different place. And they'll let you get to a certain point and then they come out and whack you over the head in all, you know, in all the ways that we all know about. So the other thing that we've found with subs that's quite scary as an acquirer is that we've sent quite a few deals into diligence, and then what's on the bottle is not in the capsule. Yeah. And that's really painful. It takes a lot of time, you know, just sending off 20 SKUs to be third-party tested. You know, you're looking at $5,000 per SKU, a couple of months. It slows deals down. So for us right now, it's a category that we kind of approach with caution. And then there's, you know, there are risks within the category. So, you know, sort of testosterone, weight loss, you know, all that kind of stuff. I think no one would ever want to go near. But you might want to look at vitamin D, you know, curcumin, you know, the more kind of natural supplements.
The standards that
naturally
formed in the body and stuff.
Yeah, and it's possibly less fatty. But I think that's the reason that we approach with caution. It's not that we don't do subs, but we're pretty nervous around it for those reasons.
Yeah, well, it's a business there's a brokerage that works not only, you know, private buyers, investment bankers and everything else. What is the general consensus across the board when it comes to supplements? Are people a little bit step-offish when it comes to that? Do they have those kind of concerns and stigma around supplements? Yeah.
Should I go? Yeah. So with supplements, when we asked buyers what was the reason for this result, we saw it. I mean, we felt it in the market. Yeah. They said several things. One, the wars between sellers in this category that, you know, we've seen in the last couple of years. The competition, obviously, but also anything related to compliance.
Yes.
So when you look at supplements, same with food, this is what deterred some of the buyers. So these are the two answers we got when we asked the questions. I think that if that's the situation, then it's actually an opportunity for many of the buyers, because once that's an obstacle for some, but once you go through that, then you're in a safe zone. But these were the two answers. Michal, you want to?
Yeah, I was going to say, do you want to add on, Michal?
So first of all, of course, I agree with what Yael mentioned. This is what we see, and I think that this is what we see also in other categories. So when the product itself becomes a bit complicated. And its sourcing or selling becomes something which is more out of the ordinary or simple course of business, then at this stage of the market, it seems that aggregators at least prefer to shy away from those categories. we are evidencing very successful deals, actually with relatively lower multiples in those categories, because there are some buyers that would specifically look to buy at these categories, and the market is the ocean is still bluer there. So this is something in our mind to consider. Supplements, as an example, it is a very strong category actually. The market is not as bad as it was as of sellers war. We see that this zone has become cleaner and more reasonable in recent in the last year, I think.
So what you're saying is the seller wars have died down. Now we've got the aggregator wars on top of the course provider wars. So what's happened? There's a slipstream. I'm joking, but no, everything goes in cycles, doesn't it? So, but what we're saying is there's still room for sellers in supplement, even though there's a little bit of stigma around it. You've got the right products and you're placed right in the market, and you're clean under the hood. Then there is a home to be had there. You could sell the business, not a problem. That's
right. And by the way, from consumer perspective, there is no question that there is a high demand for those products. So this is a strong market.
Yeah. Rob, what would you take as if you were approached with a supplement brand? What would be the criteria for you? You know, if you don't normally take it, what would drive you? Is it because it's by Dr. Such and Such and they've got a TV show and that makes life easier for differentiation, or?
Yeah, so look, I'll be very frank. A lot of supplements brands come to us either through brokers or through organic means. We are yet to acquire one, and I think the element which keeps getting us, which no one on our team has a core competence, is just understanding the compliance risks around the product, and then being able to verify the claims the product makes. You know, we've got the storyboard, a leading beauty brand that claimed it did or had certain ingredients in. You know, we acquired this in Q1, and it turns out that, you know, it didn't have that ingredient once we got it independently tested. But this was after we owned it. And obviously, we're going through the process of revising the composition of the product and the packaging, so it's not a problem. But I think that's taught us a good lesson. I think everyone here, this space is so nascent, the buyers are getting more sophisticated. So I think if a brand or a product is making a claim, such as in supplements, like, we need to be able to verify it. And that's something that we don't quite have the domain expertise yet. Now, we wouldn't rule out acquiring supplements, because I do think it's a good opportunity, as kind of Yale and Mikhail are saying, that there are a lot of sellers. There's a big demand. People are buying supplements on the platform. So it's just making sure that, you know, we understand the compliance risks and have domain expertise about that. So,
yes. Do you want to? Yeah. Was there anything you want to quickly add here?
Yeah, I just wanted to say that I think when Michal talked about opportunities, I think there's also an opportunities for buyers to look at those categories, and one of the interesting ones is toys. I think we talked about it, Rob, in one of the conferences. Some, as we saw in the survey, some of the buyers don't look at toys in general. When we ask why, they say that it's because they have a short life cycle. They're seasonal very often. And so that's a category where there's not so much competition like other categories. And so the multiples are a little lower than others these days. So an opportunity for buyers, I'd say.
Nate, we'll finish on the supplements. Obviously, we don't want to carry on giving supplements a kick in. It's not about that. It's just trying to go from one extreme to another to realize that there's always a home for someone out there. It just depends on where you look. So with supplements, is it something that Perch will take on, or it's not an area they want to touch?
We have not yet. Similar to Rob, we see a lot of them, and there are a lot of attributes that they have that I would say I love. You know, they've got really high gross margins. They've got repeat purchase. They've got sincere brand affinity, and all of that stuff is like, oh, great. But you know, aside from the points that people have already made, I also have a fear that Amazon would make a ruling that says this business doesn't exist anymore. Like you just can't sell anything with whatever it is on the platform, full stop. Like that feels like a realistic potential, or maybe your specific country of origin for this particular type of product. Yeah. And so, I can handle something where the stress case is a 20% decline in the business. I can't handle a situation where the stress case is a realistic like 0. And again, it's the sort of thing where I think if you focused exclusively on acquiring these businesses, you knew the supply chain, you had a supplier that you thought you could drive volume to, that you can trust, and you know how to operate within Black Hat. I think there's a winning business model there. And as everyone said, there's hundreds of millions of dollars, if not billions of dollars of sales being made in the category. So there's a good business to be had there. But, I think the world is big enough that I think Perch views itself as not having to be good at everything. And so for now, we're not going hard after that, or going after that at all, really.
So yeah, we pulled up on here on the screen, wholesale, resale businesses. It's pretty much a slam dunk that they only buy private label businesses, which is fine. That's most of our audience. What I'm really interested in is that some are saying that just needs a year, just more than a year in terms of trading history. Should we scroll to that? Because I thought that was very interesting.
Oh yeah.
So if you were a business setting up in January last year and were selling medical equipment of some kind and had it right off from March last year, your last 12 months trading is going to look phenomenal before the actual COVID adjustment around March, April time. So that can give you a really false sense of security of the business that you're buying. Do you want to? Can we scroll that down, Yao, to that point?
Yeah, I did. You don't see it?
Okay, let me just remove that and bring it back in. If you scroll down.
Let me share again then.
I'll
share again.
All right. I just found that interesting, because it'd be interesting to understand what you guys are making adjustments now for that COVID bump going forward, especially with shipping and stuff in the toilet as well. Can really give you a false economy if someone's paying a higher multiple on the business, and then you had the COVID bump and then you worked off of that, then didn't make the adjustment. It's going to be a bit of a rough road leading through from there. So it'd be good to understand you got minimum operating history, right? So 40% more than 1 year, 33% more than 2 years, more than 3 years, 0%, 18% for no. So Jim, starting with you, where would you feel most comfortable when you're speaking to a potential seller and you found out their trading history is 12 months or 30 months old?
Yeah, I mean, it's the beauty of Amazon is you can build a big business in a really short period of time, but to buy something that's been in existence for less than 12 months is pretty hairy. COVID has had some massive adjustments. I'm sure all the guys have seen kind of 50% drop-offs in some categories post-COVID, and it was like all within about a week, around mid-May, just numbers dropped off on certain categories or subcategories. So, short answer. Would we buy a business that only operated for 12 months? Yes, but it would have to have really strong future outlook for the category, for search trends, for consumer behavioral trends, all that kind of stuff. So if someone is just an early mover in a category that's blowing up, fantastic. But if it's someone that's another product in another category that only started 12 months ago and has somehow managed to do really well in quite a competitive environment, that feels a little bit hairy and probably would be perceived to be higher risk as an acquisition. Yeah.
What about you, Rob? What have you guys? What has your guys done in house? The data scientists, etc., and look at these numbers. What adjustments have you made for that?
Yeah, well, look, I think the worst is probably behind us in trying to unpick that COVID bump, thankfully, which makes our lives a little bit easier. But there's some new challenges there around thinking about margins with supply chain and PPC going forward. So that's kind of probably the biggest pain point at the moment. What I would say on the operating history, if it's less than 12 months old, the question which runs through our minds is, well, we can launch the product. I think people think aggregators are just about buying brands. One of our most successful brands was something we launched in 2019 that's now pushing 8 figures, which for us is a big win. So we've got a team we're building out now and launching. So if something's blowing up in a category, as Jim says, we'd probably just look at it and say, well, let's launch the brand. We've got the capital and go after it. So I think we really want things that probably have, more than 2 years of operating history. The other thing, which I think the question which runs through our mind is, someone's had so much success in a short space of time, did they do it honestly, or is this some black hat happening? And that's difficult to unpick sometimes, but having been on the platform since 2016, we can kind of suspect when something doesn't smell right, and we'll probably just stay away. So
same question to you, Nate, as well.
Yeah, the last thing I would question when someone's selling their business after 12 months is seller motivation. Like if you've got something that's growing like a weed, you only launched it 12 months ago, you can't be that tired yet. What's the reason to sell? I think we can correlate great outcomes and less desirable outcomes pretty well with like why someone in retrospect was thinking about selling. It's something that we really try to make sure we understand. And I can't think of that many amazing reasons why after 12 months somebody is that confident in the rosy future of a business but still wants to exit. And that's where I think you start to ask questions about, is this a house of cards? Is this like a lucky year? Is this built on something that we're not seeing, where the seller knows that they've built it artificially, whereas it's harder to prove. It's harder to do that for 2 years straight, for 3 years straight. Not to say that every business we buy has to be that old. 18 months is kind of the minimum that we target. But I would just add that seller motivation, you've got, I don't know why you would sell a business after a year if you have confidence in the path forward. And if you don't have confidence in the path forward, I don't either. So.
Indeed. Mikhail, just on the flip side, from the seller point of view, they get a COVID bump because obviously you want to see a hockey stick high to the right and it keeps growing. You don't want to see stagnation or drop off. How do you explain that way to the gentleman and other people around the table when you've got a seller whose sales are going in the opposite direction slightly because of the unsustainable COVID bump? How do you sell that in?
Yeah, actually, with time, the COVID impact is being clearer for sure. And actually, what we concluded relatively recently is that at least part of the COVID should be just ignored for good and for bad. So we kind of we look at 2019, we then look at the COVID period, and then we look at 2021. As if this is post-COVID. Of course, COVID is here, but different COVID style. And we create, we draw a line, and whatever is a bump above this line for the COVID, for the 2020, we take it out of the equation. What we can see many times, we can see in general two types of businesses in this context. So you may see a business that enjoyed from the COVID situation, and it was a peak which will never return, and it has not become something embedded in the business itself. But we can see other businesses that actually COVID really gave them a boost, promoted them in time. They gain more view. They strengthen their positioning. And even if they had a bump which is higher than what is shown in 2021, altogether the business has expanded. Yeah. So it may be that we'll see a graph that goes a bit up in 2020 and a bit down in 21, but compared to 19, you can see that altogether this is a growing business, and this is the more important thing. We are telling our client not to fall in love with the one spark of event in the past, but to really look at the business and what it is worth. Of course, it's easier to say what I'm saying now these days because we are 12 months after actually almost all the COVID impact, so this is an easy one.
Yeah. Well, you had me convinced, so don't worry about that.
Okay, good.
That's good. Okay. That's very well explained. Yeah, do you want to bring up? Oh, here we go. This was an interesting one in terms of minimum profit. Do you want to walk us through this, Yao? Your take on this?
Yeah, I mean, that was some of the questions did surprise us a bit. We felt, when you go to market and you speak with buyers, you feel that the minimum SDE profit margin that they're looking at is 18, 20%. And then we got these answers. Some of them said they have no minimum. 14% said that. 14% said at least 10. And 29%, which was the highest one, said at least 15%, which is quite low. And we started asking ourselves and asking buyers what was the reason? Why would they buy a business with such a low profit margin? What they said, some of them said that they simply think they can do better. So they're buying. So they see that as an opportunity because they pay less. The profit, the business has less profit. They give a multiple on the existing profit, and then they can raise it to 20 or 25%. So they won't rule out businesses that have low profit margin if they think they can do better. But that one, in my opinion, was a little surprising.
Yeah. Well, go on, Mikhail.
Sorry, is that okay? I just want to add a few words about that. I think that you can always question the extreme parts of the scale, because limiting acquisition only to huge profitability, such as 30%, this is also something to question about. I mean, if I'm a buyer, I would look very carefully if this high level of profit is sustainable. I'm not saying that it necessarily isn't, because many times we see that businesses on Amazon can run for certain years at least with such a profit level, but limiting the acquisition to this enormous profitability, it is also not that trivial.
Yeah. And of course, you don't forget you get all these YouTube videos where everyone's on 50% margins, which is utter bollocks. But, you see that and then that sets people off and they go, what do you mean 15%? That's shit. But then if you're running an 8-figure business, you've got high overheads and stuff. 15% isn't that bad. It's nice to be higher than that. You just got to be realistic. These are real businesses being run with real costs, especially in these times with how the cost of shipping and stuff's gone up. Nate, what do you look for margin wise? Is it 50% like the YouTube gurus?
I would say similar to what Mikhail said. Really high margins originally would have said like, oh, this is fantastic. Your return on investment so high. But what we've seen time and again is that Amazon's a really efficient marketplace. And if you've got something that's generating 40% margins, unless you've got defensible IP, like somebody's gonna, even if you've got great product, great merchandising, great advertising, you're doing all the right things. There's you've got to underwrite probably not maintaining 35 or 40% margins forever. And so I think it's right that there's no perfect answer for what a margin should be. What we really want to do is just understand the why. Like, why are you at 15%? If you're at 15%, because you've had no control over your shipping costs and you're mounting up huge storage fees that we think we could run more efficiently, that's okay. But if we think you're doing everything roughly right and you're at 15% margin and we're not charging for your management labor, and we know that we've got to layer on top, our own G&A, as Rob was saying, there's a bunch of people that go into running one of these businesses. All of a sudden, the actual realized economics for us, if you're at 14, 15%, are quite tight, unless we see something where we say, we know in an underwritable fashion that we can take COGS out, or our pricing model would say that there's actually room to price a little bit more confidently here. But I would say it's much easier for us to underwrite improvements to costs than it is to underwrite improvements to marketing or pricing necessarily, because one is more grounded in what we can control versus a dynamic market. But I would say my expectation for a lot of these categories is that the long-term mean of successful profit margins on these businesses is probably in the 20 to 25% range. If you're a little bit below that, it's either because you're a less compelling offer, or you're less efficient. If you're above that, it's either you have a differentiated offer, or you're just lucky for now, and it's gonna come down over time.
And going back to your point, if you're more efficient in the way that you run things in terms of your operations, you may pay a bit higher on per head, per wages for the competition in the market, but you might find a place that these people are on 15%. It's got a workforce of 60, but actually it's legacy, and they only need 12 or 13 people to fulfill those roles when you run it on an efficient basis in terms of the business.
Although one thing I'd say is at the smaller end, to say somebody's running an $8 million business by themselves with maybe 2 or 3 assistants.
Then you should worry if the margin's really tight there. Yeah,
that's a $300,000 employee that's not technically in the SDE number. That where it's real high competency wages that have to go in to replace the founder's energy. And of course, we're all building tech and platforms to do things at scale, but still there's humans that need to be doing this stuff too.
Yeah, I think a lot of people get a realization when they look at their margins and they look at the body count on their team, is when you can try and work out the valuation of per head, like how much money is generated per year through that business and the amount of people, and then split the ratios out on that. That can start to give you like a profound effect on, do I need all of these people? Am I being efficient enough, or do we look for our efficiencies elsewhere to make those changes? Jim, what's your take?
Yeah, I mean, I just don't want to say the same as Nate, but I mean, our job as an acquisitions team is to, if we're putting stuff into the business that's running at 15% or 12%, to have a very clear path to pulling it up to 20%, and it's the same levers that everyone else is talking about. So the only thing I'd say that we haven't said, which is the bigger the business that gets, sometimes the less profit it generates, which is another myth that a lot of people expect, that the big equals efficient. It doesn't. When you get to like 20 million plus, EBITDA often starts dropping down because you have more heavyweight headcount in the business, and that performance just takes a more expensive base cost, and so you start seeing 50, 100, $200 million businesses running at 15% more commonly, and 1 to 3 million, like Nate says, you can run from your bedroom with a couple of VAs and a cost base of 1%, which is not hugely realistic as you scale a business.
Yeah, Rob.
Yeah, look, I think it's case by case now. I think in the beginning we were very much laser focused on trying to buy those 30% SDE margin businesses, and obviously, if we can find those, we'll look at them quite hard. But I think the question is sustainability of margin. Certainly, if it's a low margin product, we'll kind of ask our question around, how long has that margin been like that? Because if it's been sustained and very consistent over a 5-year period, that gives you a lot of confidence that, okay, well, it's a low margin product because that's just the nature of what it is. That doesn't mean that it's not appealing to acquire. So we'll look at those questions, before we LOI in our evaluation about, do we think it's sustainable? How can we grow it? So yeah, we have looked at some low margin businesses. We do own some low margin businesses that are performing very well. It's really case by case. And I think, as Jim said, certainly, yeah, bigger businesses have lower margins when they start layering in their team costs and costs of operating at scale, like that adds up.
And the only thing I'd add to that also is that a low margin business that's low COGS is more okay than a low margin business that's high COGS. So if like fulfillment fees are eating up a bunch of your margin, we don't pay that until we sell it, and that's more tolerable than if you're paying 30% of your revenue to buy the product, get it landed, and then you're only generating a 15% return net on that. Just the economics and like what our cash is tied up in, and all of our cash would be tied up in, is very different. And so I think the net SDE margin is one part of the story, but really what we're thinking about is what cash do I have to put out and how long is it before it gets returned, in what order of magnitude.
Cool.
I want to add just about profit, if that's okay. Still 1 more minute about this topic. I think that the dealing with the margins is a bit about that. For what is the term at which a buyer is looking at? Because there is a short-term observation of a business, and then the longer term. And here we do like the case-by-case approach. Since there is no one reason that leads to low margins, there is no one conclusion that can be drawn up out of too high kind of margins. And actually, with a strong vision about the future that lies for a business, each case has its own conclusion. So usually we feel that it's our work to actually analyze what are the factors that impact the profitability and what can be done with it in the long run. This is the most important thing, to understand what the business is heading to.
Yes. Cool. So let's just wrap up the final part on deal structures. Yao, do you want to step in here?
Yeah, that's one example of the question that we ask, and I'm trying to show the more surprising ones, I guess. So most buyers want asset deals. They want to buy the assets and not the shares for several reasons. But what we saw in the survey, and then we started seeing it, I guess, in the last 6 months in the field, is that buyers are now willing to buy the company and do stock deals. Of course, they still prefer asset deals, but in many cases they're willing to be more flexible. In particular, when we're talking about UK companies, but not only, we're starting seeing that with other types of companies, US companies, even Australian. So that's a big change. With the change of multiples from last year, we're seeing now a change of the type of deals. So that was something that we confirmed it, I guess.
Cool. What's your take on this, Nate? Is it assets that you're looking at, or what's the breakdown for the philosophy behind what you guys want?
Yeah, in the US, we've only done asset purchases, and we'll continue to only do asset purchases. In the UK, there's just such a cliff of the tax impact is just so dramatic that that we decided to sort of commit to being capable of doing that where needed. But yeah, there is real complexity and challenge to it. I think there's higher deal breakage risk when you're doing a stock purchase, because when we do a stock purchase, we take on all the past liabilities. That's import liabilities, that's employment liabilities. And so it's a longer process to do the deal. There are more costs to us. There's more risk that we're going to encounter something that like has an uncomfortable surprise in terms of the sort of risk adjusted value that we see, just by nature of the risk that we're taking on and doing a stock purchase. It's definitely more complicated. I think it's something that we look at and think about what's the ultimate seller's opportunity set. And if there's just 50% of cash that's left on the table, like, are we willing to pay, like, what is our relative willingness to go through the pain of a stock purchase versus, what are we willing to pay in an asset purchase basis? And I would say that we're early in figuring out what that balance is. We haven't been burned yet by any of the liabilities. If we get burned by some of the liabilities, I'm sure that will change. Then we might say no stock purchases ever again. But for now, selectively in the UK specifically is where we do it, but not in the US.
Cool. Jim?
Yeah, all UK deals want stock purchase agreements, because of the employee entrepreneurs tax relief. So all the UK deals were doing stock purchase agreements. Sometimes in Europe's not so black and white. It depends on the seller's fiscal structure, what works. We're driven really by what the seller wants, unfortunately, or fortunately, depending on how you look at it. So if there's a big tax case in favor of the seller, then we go with a stock purchase agreement. And every deal in the UK, unless they've done a previous exit, they want the entrepreneur's tax relief. So, and in the US and Australia, sometimes as well, if there's an S corp rather than an LLC, and it's a big deal, then a stock purchase can be on the table as well. But I think for the same reasons everyone else, asset purchase agreement is much quicker to execute. Everyone wants a quick deal. It's less complicated and it's cheaper for both parties. So APAs is everyone's favorite for both sides. But a stock purchase agreement, sometimes you do it as well, mainly in the UK.
Mm-hmm. Rob?
Yeah, look, I think everyone else has touched on it. All the US deals we've done on an asset basis. We've done a couple of share deals in the UK, and it's from a tax perspective, that's just optimal for the seller. But I think, as Nate said, it takes a lot longer. We have to engage, specialist tax advisors and accounting advisors, and that takes a lot longer and comes with some expense. So that's just something to keep in mind. The sell your business in 30 days isn't quite true if you're selling a UK business. Should be more like 60 or 90. So, and I think that's something which is going to evolve in this space more generally. I think, the 30-day close, I think, is going to be extended. I think deals are taking longer, and as multiples move up, the margin for error is far less from a buyer perspective, and we're taking more risk. So we need more time to due diligence. So when you're buying something at 2x, sure, you could do a quick close in 30 days, and you'd kind of, you could take that risk basis what you were paying. But I think now, buyers are becoming more discerning, and our diligence process is become far more robust, and will likely become more robust. So
cool. So let's finish off with some predictions for the next 18 months or so. Debunking the one that Sifid shafted me on, where I said there'll be bloodshed in 18 months. Nate's boys. I didn't even know that came out, right? One of your guys emailed me, Nate. The first thing I heard about it, there will be bloodshed in 18 months. And he says, Danny, I'd like to have a chat with you about you and your colourful language. And that was the first thing I knew about it. So I'm done with predictions, because I end up speaking to the wrong people.
Colourful language. Yeah.
So I'm done with predictions, but I'd like to get yours now, because that headline will come back to haunt me.
This sounds a bit revengeful, Danny. You're trying to get something in writing from Nate to show back.
No.
You're trying to get me to say something that I'll regret.
What I mean is that is going to haunt me, because in 18 months' time, if there isn't bloodshed and the market gets smaller and it regulates, that will always come back to haunt me, is what I'm saying. So I'm not going to make any more predictions, but I'd like, as professionals, because I'm not one of you guys doing what you do, as a professional, Nate, 18 months, what's the landscape looking like for you guys? Where do you see it going?
Yeah, it depends on what you would describe bloodshed means, but
yeah.
It's the wrong direction, Nate. You should start from the beginning.
So what I would say is, right now there are, I don't know, 70. I stopped counting after like 40 or 50. Some large number of players in this space. In 3 years and 5 years, I know that number will be smaller.
Much smaller, yeah.
It'll be much smaller. Maybe 15, maybe 10. The number of publicly traded companies is going to be under 10, probably under 5. The reason being that in order to get to the escape velocity scale, you eventually need to have a 100-person engineering team to build the tech platform that's going to support a multi-billion-dollar consumer goods company. You need to have best-in-class capabilities, et cetera, et cetera. And it doesn't make sense for 10, 15, 20 of these players to do that. And so the question is, how do we get from, that's the way that markets evolve. And the question is, how do we get from here to there? It could happen, there's a happy path wherein, people get to a certain point and they decide strategically for them that, I've built a successful and growing business. I've got a great portfolio. I've got differentiated competencies that, a Thrasio or a Percher and Elevate would love to tuck into both our asset portfolio and our team portfolio, because we're all hungrily hiring and trying to find great people, right? Yeah. The rosy path is that there's, a good opportunity for a smaller player to sell to a larger player. I think in the near term, the smaller players that are selling to larger players will be distressed. Will be not doing it out of a sort of strategic decision that we're not going to invest in tech and get to the scale position, but it's more around, I ran out of money. I bought things and paid a certain price and didn't have the buffer to deal with the supply chain challenges that we're seeing. Can't raise the next round of equity based on our demonstrated performance. Debt is real. And, my underwriting model worked on paper, but not in the world that we're living in. And we're seeing that now that, the challenge for those people is that when you're selling in a distressed situation, Rob, Jim, and I are probably looking at that and also saying, this looks like kind of a mess. And you've got 15 assets that are hard to untangle. And for me to understand that I'm not also making a mistake. And so, the clean scenario is that there's people that are ready to pick up what are foundationally solid assets, but may have been mispriced or mismanaged. But the alternative is that people do go into liquidation in some capacity just because they can't find a buyer for a big portfolio that has a bunch of highs and lows, and they're needing to make a sale in a rapid time frame, in which, like, frankly, when I've looked at them, I found it to be really challenging to make a good decision. And so I've just said, I've got other less complicated things going on in my life right now. I'm going to go look at those. At some point, of course, we're all going to need to really think seriously about kind of how that consolidation happens. And I think I'm really keen to see how it plays out. I think it's going to be hard, but there's going to be a lot of rewarding activity that happens. Say, one player has the best tech platform, the other player has the best in class sourcing team. Like, there's real value in bringing those together in a thoughtful and methodical approach. I think the place where, I don't want to say bloodshed again, but the place where there's more chaos is when somebody has to do it.
See what I mean? I'm not going to be the end of it.
Where somebody has to do it, and that is going to happen time and again, because I do think that I don't know. I've looked at assets that I've been outpriced on by 40%, and I followed their performance afterwards, and that's a really painful investment that people with a small buffer on their balance sheet have made, and so it's gonna happen, and it is happening now.
Cool, Rob. Your predictions that doesn't include bloodshed in the next 18 months.
Look, I'm a bit more kind of glass half full type person. A lot of people are out there kind of slagging aggregators, saying that everyone's going to fail and it's going to be a bloodbath. I don't completely agree with that.
But I don't agree with that. And that story, I said to the woman, please, I'm going to give you a balanced view on things, but I want you to know aggregators in the space. Someone actually pointed out the other day that in pink, in small letters, it mentions that the aggregators are good for the space. But going back to the point, we had a conversation the other day, Rob. Last week, the aggregators get the shit kicked out of them. This week may be Helium 10's turn, because suddenly Explorer's come out and it's got search volume. So that Helium 10 might get a hiding. Next week, it'll be my turn for Seller Poll. It'll be someone else's. Yeah, will get a hiding for something. The world goes round. And the fact is, you guys bring value to the space. If they want to piss and moan about it, it's entirely up to them. But legacy money's been made in this space. People are exiting. You bring value. You buy a business at your valuation. Most of the time, criticism comes from below, not above, right? Yep. So you're going to get a backlash, I'm afraid. Yeah. It's called human nature.
Yeah. So I think the predictions are, I think the smaller groups who are kind of undercapitalized and don't have the operating expertise will, they will kind of stagnate and be forced to be distressed sellers. So whether that's a failure or not, that's already happening. We're seeing it. I think bigger groups will continue to raise capital and accelerate, and then there'll be some consolidation at some point of the bigger groups. I'm not talking about a big guy buying a small aggregator with 10 assets. We're talking consolidation at the upper end, because obviously the bigger groups grow, they do bigger deals to move the needle. And if there's other aggregators with solid portfolios and there's synergy and every group has their strengths, then that can be a really positive combination, I think. So that's that. And I think there'll be, $10 billion has been raised this year. Maybe it's 20 next year. So it's a fantastic time to be a seller. I think it's a golden period here.
Yeah, I agree. Even if there will be bloodshed. No, it's joking. Jim, what's your take? What can we see in the next 18 months? Let's look at there's
nothing to add on the aggregators. I think we'll see the same. We see some guys are really good at what they do, and other guys are going to struggle, and already that's manifesting itself in people offloading portfolios. So that's nature. I mean, we reckon there might be 10 left in a year or two. What does that look like? I mean, it could be that people at this table end up sitting at the table together, not just here, but there could be some of the big guys joining parties. I think one thing we all believe is that the future is all about data and technology, and we're, Nate said we've got 400 plus people in tech and data now. I have no idea what they're doing, but I know that the magic that comes out of there, and it allows the decisions that we make to be de-risked and more powerful. And I think that's really where the future is for small sellers, because Opportunity Finder also brings massive data to the man on the street, right? So, yes, we've got this team of 400 people doing God knows what in a black box, but, Opportunity Finder shows that if you know what to do with that, and there'll be little specialist agencies that will pull dynamite from that allows the entrepreneur to still keep finding categories that the big old aggregators are actually a little bit slow and focused on what they're doing than to really find that emerging thing. So I don't know, I think it's still full of opportunity. I think the platform's going to get tougher. It's going to get professionalized. There's going to be price compression. Advertising costs are going up. Supply chain is going to restructure out of China and other places. So, everyone's got to be kept on their toes. But, like Rob said, I just think the opportunity is still massive for aggregators and entrepreneurs alike.
Yeah. Ladies, final words from you. What's your predictions for the next 18 months or so?
So first of all, we are hearing here the birds themselves singing. So we believe that whatever these guys here said should be about it. It seems that the market will be more interesting over time. The existing aggregators, those who will survive those drastic events that you mentioned, will become more mature. We'll be able to make more advanced steps alongside newcomers into the industry. So altogether, it seems that the market should be more diversified, and also in the deals themselves, in the acquisitions themselves. We believe that sellers, with time, they already are today much more educated than they were in the past. So potentially, all the market, all sellers will be 100% or close to that educated about their ability to sell the business, to build the business in order to sell the business, how to sell a business, how you should work around it, what you are entitled to get. So it will become a more mature market. This is and therefore more interesting for us as well. We're fortunate as service providers, but for everyone. And I'm sure that no one of the guys that are sitting here will be part of the disappearing.
I'm convinced these three companies will still be standing at the finish line.
Right.
Yeah, I'm convinced on that. I might get everything else wrong, but I think 18 months we'll still see these three, maybe not these gentlemen themselves, but these three companies will still be at the table. Because they might have aggregated each other. They may aggregate each other. You never know. They might be under one team. They might all go work for Jim. They could end up working for Jim. You never know.
And then we'll end up working for you, Danny.
No. That would never happen. I'm unemployable. What's your predictions? Come on.
Well, like Michal said, new types of buyers that we've been seeing, I guess, in the last year, more strategic buyers, private equity firms that we're seeing coming in, maybe less aggregators, maybe, but the stronger one are getting stronger. I think we're not going to see less deals. We're going to see way more deals than we're seeing today. This M&A market on Amazon is kind of endless if you compare it to other markets. In other markets, companies are buying each other, consolidating until there are two companies. In our space, Amazon space, you can't. It's not. I mean, it's all the categories. It's kitchen. So it will never end, in my opinion. And we're going to see more deals.
Yes, cool. All right, I think it's time to sign off. Jim, best way that people can reach you if they would like to have a chat?
I'm on LinkedIn, Jim Man with 2 N's, or jim.man with 2 N's at thras.io.
Cool. Nate?
I'm Nate Jackson on LinkedIn and Nate at perchhq.com. Happy to talk with anybody who's interested in talking about any of this stuff. It's fun.
Thanks. And Rob?
Rob at elevatebrands.com or just Robert Bell on LinkedIn.
Cool. Ladies?
Yeah, so, Billy, LinkedIn, and Michal, go ahead.
Yeah, cool. Michal Baumwald-Doron on LinkedIn, and fortunate.net. It's a website. And we are available there.
Cool. Thank you for your open honesty today, guys. I think we had a really good round table. I'm looking forward to getting the feedback. We'll do some more of these in the future. I'll sign off now. Sharon Evan will be back in the chair tomorrow, me and Yao are going to be back here on Friday for Seller Poll, and we'll have some of the results of where we are currently at the midpoint, and we'll go back over the rules again because everyone asks me all the time about the rules for Seller Poll. Obviously, Seller Poll is brought to you by Fortinet as well. So take care of yourself and your family. Sharon's back tomorrow. Much love, and I'll see you soon. Bye.
Thank you.
Bye.